right, ladies and gentlemen, thank you so much for joining us. It's a pleasure to have you here in town, and we very much look forward to hearing your perspectives and insights on the first topic of the panel discussion. We are actually almost reaching the end of the first quarter, still amidst uncertainty. So looking forward, what are the key macroeconomic risks that we should be concerned of for the year? So let's begin with Ekaterina.
I would say, looking at 2024, the risk relative to 2023 and 22 are somewhat more balanced. And I would say reflecting on the relentless tightening of monetary policy that we've seen, obviously, over the last 2 years, with central banks aiming to curb down the inflation, certainly that volatility is expected to subside as we're getting closer to the targets with regards to inflation. So I would say the risks are somewhat more balanced, but there is, of course, residual risk where the inflation could potentially surprise on the upside. We obviously had the CPI numbers that just came yesterday, which was somewhat in line. But again, we have to be quite cognizant that until the policymakers have a certainty, particularly on a core part of the inflation, that inflation is well ingrained and well anchored, or not ingrained, well anchored, I think there's still risks or two-way risks that potentially could surface for the 2024. But I say, broadly, it's well more balanced, and if you look at the reaction for the market last night, certainly has been more positive, where the direction of travel for the central banks is set. I think the indications are that the summer will be probably the time when the central bank will start moving an easing monetary policy, and I think setting that direction of travel, regardless of the magnitude of the rate cuts that we're going to have in 2024, the direction of travel is set, and certainly puts the market into a better framework with regards to potential growth into the end of the year. And as I said, the part that is most important for risk assets for this year is central banks cutting, but not cutting into a recessionary environment. And I think the signs at the moment are that the central banks will start normalizing, again, normalizing monetary policy in line with the current growth, but not aggressively cutting rates, which is more kind of reliant on an end of the cycle recessionary environment. So I think the fact that the central banks have indicated the desire to ease, and also the fact that it's not going to be due to recession, I think it's important, it's quite constructive for risk assets. I would say risks are still there, but are relatively more balanced for this year.
Mr. Freeman?
Yeah, I will concur to the comment there. I think a lot of investors has been expecting the rate cut in first quarter, second quarter, third quarter. We do believe the rate is going to stay higher for longer. And one of the key risks that a lot of people forgot is a lot of countries are now reshoring the manufacturing back to their hometown. The inflation environment may not be as low as the people expected. If the rate is going to stay high and you keep on expecting the next, the Fed fund rate is going to cut, then the risk of underinvestment and also the risk of expecting too much of the rate cut, then that will be a risk for the investment market as well. And back to the one point that I think in 2023 and 2024 concern is about the geopolitical tension. I think no matter how you see it, this year is a year of election. At the end of this year, is a U.S. election is also creating some of the uncertainty in the market. Would that be affecting the overall economic cycle or the policy that impacting the U.S., China, or even the Middle East? I think that will be another area that we need to pay more attention on that.
I see. So as for the expectations on the rate cuts with the hotter than expected CPI data that just came out last night, according to what you mentioned, so the Fed would have to be more cautious, I would say. So when do you see the cuts happening this year? It was expected in June, is that correct? Will that still be the case?
Yeah, I think that the central scenario for us, and as we formulated the outlook for 2024, the central scenario is still June. And I would say it'll be quite a big surprise if the central banks will deviate from that, where market is already kind of expecting quite a bit that June will be the time to move. And as I said earlier, the magnitude is somewhat relevant, but not as relevant. The direction of travel and the fact that we are going into an easing cycle, I think, is more important. Whatever they move 3 times or 4 times, it's not as important. And it could be that they move in June and they pause. But I think the indications, I think June, we still have another 3 prints until the June rate hike. And of course, the core inflation is still a consideration. The headline is well decelerating. The core where we need to pay a lot more attention, which is related to labor and some of the housing market. But certainly there is still more prints to then. So I think the central scenario is still June. Again, the pace of that could vary, but still that's important. I think the key part, and as I said, the key part for risk assets is for the Fed not to make a policy mistake, or at least for the economy not to weaken significant enough for the central banks to ease into a recession. And I think that's what is negative for risk assets. If monetary policy starts to normalize in the environment that is still conducive, the growth is subdued, but not recessionary, I think that is, it's constructive for risk assets. And I think the central scenario for us for 2024 is non-recessionary. The economy is slowing down, but we do have that room where the likelihood for the Feds to engineer that ability to normalize policy but not be cutting into recession, it's more likely. So I think that's important part to
Pictet, what's your house view on this? And of course, also about the recession, deceleration.
Sure.
Should we be concerned about this?
Okay, for Pictet Asset Management, we don't encourage the people don't guess the time of the rate cut or the interest rate, because when you look at the year of 2023, the people are expecting in Q1 is going to rate cut. Now with Powell and also the Federal Reserve, the governor, saying that they may not be the case in the first quarter, now postponing into Q2, then the people keep on waiting and waiting. But one point that I need to make clear is the direction is already there. There's no more rate hike in the US. You are now expecting when is that going to come down, but the trend is already there. You have to pay attention. What next? If the rate is peak starting to come down, no matter it's September, December, or even next year, but the rate is peak and starting to come down, then that would be the opportunity for the investor to think what kind of investment when the rate is peak starting to come down. So I think this is more important than you to guessing when is the rate is going to come down. And then back to the recession area. If really the overall economic right now is not in the mode of recession, okay, we don't believe there will be some country that may be technical recession, or some part of the country, small country, may go to recession. But we don't think the big economy is going to recession. If that is the case, growing demand and also the rate is peaking, what kind of environment that we are entering into? So we do believe on the capital market, that would be one area that you have to pay attention. So in general, for Pictet, we do believe the event is already coming, meaning that the rate is peak and starting to come down. Don't estimate or guessing when is that going to cut, but it's already coming down on the rate. Then you have to make some presumption what kind of investment area that will benefit on the environment.
Let's dive a little bit more into the macroeconomic risks that you mentioned earlier. It's a year of elections. We have the US election coming up, UK, EU, India as well. Now, what will be the implications on the fiscal policies, and how will it directly impact assets? Who would like to share their view?
Okay, I'll go first, and then you can add on to that. Okay, so I think this is more sensitive question is how do we see the election in US? I think that is a lot of people, a lot of concern, and also some uncertainty will be created in the market. We don't want to give you an outcome that we expect. We just want to try to say that is, no matter how you look at is a Democrat or the Republican to be the president, the tension between the two big countries will continue to be there. So that was the one key part. So because the two biggest countries are now coming to the not fight, at least they're trying to be taking the lead of the world, then that will be the chances the government, no matter which party, will continue to be having some policy that will be firming up the growth of their own country. So we do expect in the Q4 of this year, when the US election coming to be more closer, the market will be having some volatility. And then in particular, guessing is a Republican or Democrat. So that will be one of the key risks in the market that I mentioned in the beginning. But is that a risk that will make the market to go down significantly? No. We do believe this is the risk for the people to take a look, no matter how you look at it, focus on the area that both countries will be focusing on gaining the goal. Look at last 2 years when the Biden administration trying to be to discuss with China about the reshoring and then having some semiconductor bending. But one common goal between China and US is about environmental goal. If that is the case, then we don't need to guess. No matter it's a Republican or Democrat, then just focus on the common goal for those two countries. Environmental focus will be the area that will not be impacted by the policy or by whoever to be the president, then that will be the area.
Ekaterina?
Yeah, and I think I have to say there is a likelihood that the US and China will stay strategic competitors, whatever that's political, economic, or technological advancement. And I have to agree that it's irrelevant at the moment who is going to win. Ultimately, those strategic competition will stay for the remainder of the year, and certainly for the next term, whoever wins. And I think the cooperation and transnational interest, I think, is going to exist, which I agree with those elements of energy transition. And when it comes to ambitions of US on that transition, but also for China in terms of energy sufficiency and independence, but also the fact that China dominates with regards to renewable energy in terms of the production of some of the parts for the energy transition, and also the natural resources that go into whatever that's EVs or the solar panels or the windmills. I think China still dominates, which indirectly will benefit China as the economies, not just US, but as the economies migrate to that new norm of more sustainable energy sources. And the last and not least, I think to say that China and US will stay trading partners. They are strong trading partners. If you look at 2022, they had about 700 billion of trading between the two countries, and the surplus in China is still there, close to about 300 billion of surplus of China trading with US. So it is undoubtable that we'll stay trading partners, but the competition will continue, and I agree for investors staying focused on themes that are expected to benefit from that competition of where the governments are deploying money. If you look at US, the CHIP Act, which is aiming to lift US or bring US to more independence in production of chip or manufacturing of chips, the ambition for China to become more technologically independent, that's going to help the technological theme, the automation themes, because it lifts that theme above the macroeconomic challenge or political challenges, because there is a government support to those ambitions. Yeah.
Can I add on one more comment? I think a lot of people pay attention on the semiconductor, as mentioned. One key part that a lot of people forgot one thing is 2 years ago, when you make the semiconductor in the emerging market, the cost of the semiconductor is much more cheaper than you reshoring back to the US. Now, with a lot of companies now reshoring the manufacturing of the semiconductor back to their hometown, or even the EV car, the Chinese company are trying to build their own premises in Europe to build their own car and then to be distributed in Europe. The cost of individual component is much more higher than the cost of in the emerging market. So when we look at the world in the coming 2 years, don't overestimate the inflation is going to come down sharply. The reshoring concept is a lot of people misunderstanding. Oh, reshoring is good for the company, good for the country. But that will create a sustainable inflation environment for those countries. So that is one of the reasons why, back to the second question, is the rate environment. Just don't guess when is that going to come. Yeah.
All right, let's go over to Ifan, an expert on China. Mr. Bing, in your perspectives, how do you see the US elections shaping the US-China relationship this year? More room for collaboration, more tension, what do you see?
First, thank you. It's good to have these questions after the New World Order sharings. So I wouldn't say this is part of the New World Order, but to me, as a portfolio manager, I think number one, US-China election is more like a idiosyncratic risk to me, to the markets. Like, even though I know the directions, what's the implication for equity, fixed income, or property price? That could something like worth a debate. To me, at least number one, I think the whole market is less sensitive to the US-China election results comparing with 2016 and 2018, even 2020.
Even if Trump wins?
Yeah, of course, less sensitive. That's number one. Risk meaning uncertainty. So if anyone expecting an uncertainty environment in the front, they normally shorter their durations and parking their money into defensive assets. For example, money market fund. That's all over the world. We see the trends. Number two is, as a portfolio manager, I also want to see what has been priced in. Basically, how bad it can be, and whether the price has been reflecting that bad news. One angle I look at this is, in the past maybe 1 or 3 months, everything coming back to China is negative news. I seldomly see some positive news for China, which to me is a kind of a good news. Especially when I see another figure, is the total market cap of China A companies is roughly 10 trillion USD at the moment. Magnificent 7 is 13 trillion. If anyone believes a whole country revenue is less than 7 countries, you can definitely bet your pots on the other optimistic parts. Else, for me, I'm kind of tends to believe on mean reversion. That's basically a cycle of the market. And last points I want to make is for this election, especially election year around the globe, this whole market is looking for, I think, at least for China assets, they're looking for momentum trading opportunities. I'll say in most of the times, the GDP growth of China doesn't really correlate with the performance of the stock markets, mainly because of the valuation distortions. But at this time, at this certain moment, if you're looking at depressed valuation and a not so bad earning, I think I'll leave that call to the audience to make.
Now you mentioned about the stock markets. Let me ask you a bit about the recovery trajectory. How is it looking like? Any bright spots for investors now? Although we see that the markets have rallied in the past few weeks, will this uptrend be sustainable? What are the opportunities?
Yeah, I think I'll kickstart and leave the rest to the panelists. I do see silver linings around the clouds, especially in the past 1 month. So the market started rallying. Part of the reason is because of the regulator stepping in to stop this spiral, the whole markets. So once again, we're looking at a very traditional earning and valuation point of view. It goes without saying that the earning of Chinese market actually stepping down. So that's something you can see. If you're looking at that from a very traditional Dubon ROE formulations, the coming down mostly coming from, number one, the margin compression. Number two, the turnover rate has been going down, meaning there's a lot of inventories and there's not a lot of bargaining powers. I think that related back to the macro environments we mentioned earlier. Coming back to the spot or the bright spots, number one is definitely the value compression I mentioned earlier. Number two is about the opportunities from China is not really on the whole beta, but rather on the alpha. I definitely believe China is going through a rebalancing stage, meaning some of the industries we know they will not enjoy the old laurel anymore. Some of the industries under transition, and some of the new industries, especially those can generating overseas revenue, or they can enjoy the government tailwinds, they will win. They will start from a small cap to mid cap to large cap until they can deliver a sustainable ROE. That's my take.
Will the recovery be sector specific? You'd like to share, please?
Yeah, and I think I'll just dial a little bit back because last week was a big week for China in terms of National People's Congress. And in terms of the results of, or at least what the expectations were, and I say the package that has been put through, it wasn't surprising in any way, but I certainly gave some guidance of the commitment of the government policymakers to help China transition, again, to the point said earlier, China is going through a transition from a levered economy into an economy that is wanting to focus more on consumption and certainly less dependent on export, but not also dependent less on exports, but improving the quality of exports or the China value in the manufacturing, global manufacturing chain to go a scale up or scale that quality of manufacturing. So certainly the ability for China to go through that transition will trickle through the better outcome for earnings on companies and certainly the better results for the equity market. So I'd say the first rally that we've seen, or the rally that we've seen through last week, is certainly an indication that, or some signs the government has given with regards to ability or desire to support the growth. I think the part that was the most surprising is that for now, China is still very much supply focused. What does it mean? They've done less to support the consumption for now, and the reason they do so is that for China needs to recover growth before they can go and make all the structural changes And investment is the easiest way for China to continue the growth and achieve the 5% target. And I would say that more measures are needed to support other parts of the economy and certainly support the consumer. And certainly, as we go down in 2024, the more support we see away from supply side type of support, which is focused on investment and infrastructure, more into consumer, and certainly more into places like technology. Certainly, that's going to support new economies or new sectors, new companies. I would say for the first stage, quality in China is still relevant. And as we move into the later part of the year, as we have the Fed that pauses and reverses the monetary policy, will help China with their monetary aid as well, or help them to support the economy in cutting the interest rates, which I think is positive, and certainly more measures around consumer, which are going to support consumer electronics potentially, and certainly measures to support technology advancement will potentially give a shift to other sectors or bring back into light sectors that are important for strategical point of view.
Mr. Freeman?
Yeah, I think I agree with the one point is now China has already been transformed from an export country into a domestic consumption-driven country. I think in Thailand, during the Chinese New Year, you have seen a lot of Chinese people has already come because you don't need a visa to come into the Thailand already. And with China government right now, they have already opened up with a lot more country that you don't need a visa to go to that, like Singapore, like in Europe. So what we see right now, a lot of people, I think they don't pay too much attention on that. A lot of people pay attention over the last 2 years about the policy change on the property sector, on the technology sector, on the educational sector. But now they are supporting the domestic growth. When we evaluate the whole country right now, China has changed to the way that supporting the domestic consumption will drive the demand or the GDP growth more significant contribution than before. So that is one part. Second, they need to open up to the world, allowing the Chinese to be one of the consumption driver within the country as well, like just I mentioned, in Asia, in Europe. So we do see the number of the Chinese investor for the domestic consumption in 2024 Chinese New Year has already been gone up compared to 2023, 30% of the revenue. And then when you compare to 2019, before the COVID, it's already higher. So that is a bright spot, but the people don't pay too much attention. So what kind of benefit? I can share with you one more thing is last year, I was in Shanghai and also in the Hainan area with my manager of the premium brand. The LV, Christian Dior, they just recently opened a new store in Hainan. And then in Shanghai, when you go to Shanghai, Christian Dior opened a restaurant in Shanghai that you can book a restaurant or the Christian Dior premises have there. If you don't have the confidence in China for the consumption, why you are spending that money to open a shop in Hainan and Shanghai? So that is a bright spot that someone didn't pay attention. Now it's come to the real world. Now we do believe this is a year that will be translating into a good revenue.
One quick question on China before we move on to our next topic. We have about 5 minutes left. When to increase exposure in China? When? Now? When to increase exposure in China? I mean, with all the good news we hear, with the bright spots, should we jump in now or should we wait for the right time?
Well, I think I'll take that for my 2 cents. We closely monitor the flows. The market is driven by flows. The honest answer is always coming from the money flow. So from a trading point of view, so I think the Sharpe ratio for China markets is improved a lot for the past 1 month. From the cross-border flows, we do see an increased asset allocation or money flows through either the QFII quota, QFII channel, or mutual fund recognition channel, or from the Connect coming back into China. And that's also part of the reason driving that. And in terms of the domestic markets, many people are using ETF to trade on the market momentum, especially when the market is coming down from a bottoming up stage. The ETF trading volumes, if I'm looking at the top 10 highly liquid traded securities in the markets, in Hong Kong markets, US markets, and Chinese markets this year, they all have 3 ETFs among the top 10, which once again, US, Hong Kong, and China A shares are in line. So from all of these, I'll say at least I see some trading momentums coming back. But the sustainability, it definitely needs more time to watch.
All right, a slower but a healthier dragon. Anyway, moving on to our next question. We have just about 3 minutes or so left. Under these circumstances, the current macro environment, which asset class is your house positive on?
I would say we talked about macro, we talked about equity in China equity. I think what investors should not forget and certainly focus a lot more on is bonds. We've talked about fixed income being or coming back into spotlight for investors. Again, we had 2 difficult years, or at least 2022 was quite difficult. 2023, towards the year end, saw a rally. But 2024, as I said, the opportunity set is much, much better, much richer. All-in yields are very attractive. With certainly the carry that you can generate from fixed income, it's much better. And the two-side volatility, the volatility is certainly, particularly from the rate side, has subsided. So we'd say all-in yield are attracted to fixed income, particularly in places like high yield, where the difference relative to dividends, if you look at equities on a dividend or yield comparison, the yield for equities in most markets does not make, they're not as attractive relative to fixed income, particularly in high yield, where the difference in the US is around 5%. So again, if you take additional risk relative to equities, or arguably similar risk to equities, high yield now, it's in a better spotlight on a relative basis on yield that you can harness from that. And the other second point to say is that a lot of the fixed income will get supported by yield buyers. We see a lot of investors coming back into fixed income, whatever that's IG or high yield, and supporting that through a technical spread tightening, or supporting the spreads in that regard for fixed income. And then when it comes to equities, I would say, rather than looking at countries, and I said earlier, themes are becoming much more relevant. If you look at the rally year to date, it's been very concentrated. So places like technology, places like quality has stayed a lot more resilient. One, because it's supported by secular shifts in how the consumers and the consumer behavior, but also the secular shifts in technology, the AI, but also the government support that we've seen in the US and other parts of the global economies. And certainly themes I expect to stay more resilient. So I would say cross boundaries across countries and stay invested in themes. So I would say fixed income, if you take a lot more risk, high yielding fixed income, I would say themes and equities.
Mr. Freeman, what assets are you bullish on?
Sure. We do bullish on the whole capital market, because the one key point that we do see, the rate is starting to come down. Money is going to starting to flow back from money market, fixed term deposit back to the capital market. Fixed income, equity will benefit on that. So we see the reason over the last year, money is starting to flow back. They identify one sector to invest, which is technology. As mentioned, it went up by significant. Now for investor, you have to find the hidden gem for the next phase, because the technology cannot go up forever, right? 100% 1 year, can that be last for another 100? No, I don't think so. So you have to find the next phase. For us, 2 key. One, no matter how you see the US and China tension going forward, one common goal is the environmental. So we do believe the environmental is one of the key aspects in the coming future for the investor to get in there. Back to the last question. Do we started to invest in China? Yes. Last year, we started to invest into China A environmental, because we do believe undervalue, as mentioned, and also the growth aspect that without too much of the policy risk. So second is about the theme that I just mentioned. The consumer sentiment globally actually has been starting to uptick quite a bit. And then we do believe the overall consumption market is going to start booming quite rapidly, in particular with the driver of the Chinese tourists starting to come out to the world. Second, a lot of people forgot, this year is a year of not only election, it's a year of event. We have Taylor Swift in Asia, and then going to Europe. If you join my session, I will talk more about that. Second is about the soccer, the final in Europe. And the last one, a lot of people forgot, is the Olympic in 2024 in Paris. So all this event, what are you going to do? You're going to buy a ticket, go to the country, and then what? Spending. So consumer is another area that we do believe is a strong driver in 2024.
Okay, let's end the session with Mr. Bing.
Sure. So I fly from Singapore here, so I missed Taylor Swift, but I hope I won't miss is number 1. So we're definitely watching closely about the cryptocurrency opportunities, whether that are going to become a mainstream asset classes as mentioned in the opening speech by Madam Chairwoman. Number two, coming back to equity, I think a barbell approach will be proper. One side is focusing on artificial intelligence-related technologies. The other side is looking at the income-generating defensive assets. And coming back to multi-assets, we definitely believe on the global asset allocations. That's coming to the US, Japan, India, emerging market, China. So everyone just needs to, if you're looking at your own pension, I think the only free lunch in the world is a diversification.
All right. Okay, time's up. So thank you very much. Thank you for giving us a broader sense of the macroeconomic environment and how we can navigate this roadmap of uncertainty with the investment advices given. A big round of applause, please, to thank our speakers. Ms. E. Katharina from AXA Investment Managers, Mr. Bing Fan from eFund, and Mr. Freeman Sang from Pictet Asset Management. Thank you so much.